Well, hello everyone. It's John Strebler, editor of JSIO, John Strebler's Investment Outlook, a weekly newsletter dealing with stocks, bonds, currencies, but especially the precious metals, gold, silver, platinum, and the mining shares. So it's Wednesday, and we're going to take a look at a few of the highlights today from the most recent newsletter that came out Sunday evening. And then, as promised, we're going to consider the current mania in technology stocks, AI stocks especially, and see if it looks like it's another dot-com bubble, repeating the history of 25 years ago. So let's switch over to the different view, and so that's what we're going to do in a moment. But first up is the newsletter discussing last week, and I'm just going to focus on a few highlights. The Dow Jones Industrial Average, this chart shows 18 months worth of chart behavior. And you notice that the Dow peaked out back last November, and then it matched that early this year. And now it's back up there again a couple of times, most recently sold off. Well, my thought is that the chances are the stock market is going to continue going up, and the Dow is going to blast through this level here and continue moving higher. So on this dip that we're seeing recently, I think it's a buying opportunity. Something else that kind of confirms that same thought is the MDI, Market Direction Indicator. And you'll notice that there's a trend line that has been going higher, an upward trend line. And the decline we saw last week came right about to that trend line. And it's held. Since then, it's moved up a bit. So I'm betting that the market's going to hold in here. And I'm betting that it's going to continue moving higher. We've had a little bit of correction that I was looking for. I was hoping that it'd be bigger, but you never know. Anyway, I'm suggesting that it's not a bad time to add to your stocks, especially in the tech area. These other things, we're not really going to worry about them. I do want to point out, though, with gold, here's the price of spot gold over the last 18 months, and you'll notice the last few months it's been going sideways. It's hanging on to all of those nice gains, going sideways, and I think here also we're going to see it blast off on the upside. We're going to see gold move higher, especially considering the seasonal tendencies. Gold has a 50-year history of reaching a low sometime during the early summer, typically, and then by September, October, if not earlier, it starts moving higher, and it moves higher all the way into, December and January of the next year. So the odds are in gold's favor, moving higher, and so we're holding on to all of our gold, obviously. So last week, big story was in the tech stocks. Microsoft and Meta both came out with big earnings. And so the tech shares soared on Thursday, I think it was, big move up. But the rest of the stock market really didn't participate that much. And here I'm comparing, this is a 1-month chart, shows 1 month worth of price history. The tech stocks have been doing that, and the Dow Jones Industrial Average and the rest of the market doing that. So a real dichotomy in the market, showing the advantage that tech shares have had for quite a while, actually. I expect it'll continue. I've recommended XLK in green here. Now, this is a 3-month chart, by the way. No, wait a minute. No, this is 1 month still. My bad. XLK recommended that for many, many months. It's an ETF, exchange-traded fund that invests in a variety of tech shares. And so we've been owning that for a long, long, long time. So here's what XLK has been doing over the last month or so, not so much. I recommended 3 shares. 2 of them have tanked, Globe and ASML. Both of those are down even further this week. They just don't seem to be working out, and I got rid of most of those shares because you try to kick out the bad ones and hold on to the good ones. Well, the good one's been ANET. It's up today even more. It made a new all-time high. It's up, something like 5% today alone. So ANET, hang on to that. Maybe get rid of these other ones, or at least lighten up. And definitely hang on to XLK. That's our main tech share there. Well, I'm going to slip through most of the rest of this. You can read the newsletter on your own. You probably already have. But I just wanted to focus on this one story. Thinking is becoming a luxury good. Well, in economics, a luxury good is something that people pay for no matter what the price if they're wealthy. Whereas people who aren't wealthy, they typically can't buy it at all. And they're saying that thinking is becoming one of those. And it's a real interesting article from the New York Times last Thursday. And I hope that you've at least read this. But the fact is that in America and to a lesser degree the rest of the world, people are getting most of their information. They're spending most of their time from their frickin' cell phones or the internet. So they get short little blurbs of information. And they do not bother to look into it. They do not bother to fact check. They accept whatever they're told in these tiny little spurts of information. Well, as you might imagine, that's not good for people's ability to think critically, to make wise decisions based on, good information. It goes a long, long way to explain why Donald Trump has been elected twice. I'll put $1,000 on if anybody wants to prove me wrong. There is no good reason for any truly patriotic American of any political stripe other than a fascist. There's no good reason for anybody to support President Trump. And so those who are supporting him do so because they do not know who he is and they do not know what his actions have been. Right? They read these little blurbs, they watch these little blurbs on Fox News or whatever. They are not getting the whole story. They are not getting the real story. And they don't know how to think critically. They don't know how to, check into these things and find out if they're true or not. And that does not bode well for the United States of America and to a lesser degree the rest of the world. So, that's it for my little soapbox, but it's a pretty interesting story, though sad. Let's get away from that, though, and go back and look at this idea of AI that we're in, the big move up in prices in AI. Is that a bubble or not a bubble that's going to pop? So here's a few things for us to consider as we take a look at that. The dot-com bubble, what is that doing up there? Oh, that doesn't belong there. The dot-com bubble of the late 1990s took share prices of technology companies sharply higher as the internet was discovered and just changed the world in so many countless ways. But then prices collapsed. By 2001, prices were way down. People lost tons of money. This chart stops as of 2021. But even by then, you can see that the price of tech shares had gone up pretty darn far, about as much as the dot-com bubble. Well, since 2021, they've gone up a lot higher. Yeah, we'll take a look at that later, sorry. Here's a little closer look at the dot-com bubble. It started really in the early 1990s. When stock prices were just moseying along, not doing too much, started really picking up speed about 1998, 1999, and then into early 2000. Here's an interesting little notation that this one company, a tech stock called theglobe.com, the globe.com went public in late 1998. And it rose by 600% the day that it came out. And it closed at $63.50 a share. So this is right in the middle of all this malarkey. So $63.50 a share. By the time the bubble popped, the company was selling for 16 cents a share, and it was delisted from the stock exchange, no longer trading. And so this is the kind of disastrous thing that people experienced with the dot-com bubble, and they're worried that, that history might repeat itself. To take an even different look at it, look at some numbers. Here's the NASDAQ which has a lot of technology shares. By 1991, it was up 20% from 1985 when this chart started. It was up 20% by 1991. Eventually, it ended up being 1,585% higher than 1985. And then the crash came, and it went from up 1,585% to only up 320. Well, if you bought back here, 320% gain is not bad at all. But if you bought in here, or God forbid, up here, you probably lost everything, lost your shirt. That works out to be an 80% loss from 1585 down to 320. That's an 80% loss if you had bought at the top. So now we're going to look and compare these two. Here's the dot-com bubble that we were just looking at. And here's where we are today. And today's action makes the dot-com bubble look very tame. So why are AI stocks, artificial intelligence, why are they going up so high? Well, we read more and more, we see it every single day, more and more, about how AI is doing incredible things, unimaginable things that are going to change our lives, change the world in ways that we can't even, literally, can't even imagine. And they're good ways, for the most part. They're going to increase efficiency, they're going to increase information, they're going to increase productivity, all these good things, even though we all know they have the ability, the possibility to do some really nasty stuff if they decide that they want to get rid of these inferior humans. But nevertheless, AI shares are soaring because of the expectations that it will change our lives in just incredible, unimaginable ways. Well, okay, that's fine. But what happens if we're looking at another bubble, like the dot-com bubble? Remember the dot-com bubble ended up losing 80%? What happens if the NASDAQ, here's a chart of the NASDAQ, a point and figure chart, what happens if it drops 80%? Well, we're currently around 21,000 on the NASDAQ. An 80% decline would take it below 3,000. So from 21,000 today down to 3,000 or so, where there's some nice support, incidentally. But that would do a pretty good job of wiping everybody out. So the big question, of course, is will that happen? And of course, nobody knows. I mean, I certainly don't know. It's a distinct possibility. That's why you don't want to put all your eggs in one basket. You don't want to have all of your money in these tech stocks. But my guess is that it's going to continue. We may well see a correction. We may well see it go sideways for a year or so. But eventually, I think it'll probably continue higher, possibly quite a bit higher. So I'm recommending that we stay with the tech shares. We add to them on this dip, get rid of the losers, add to the winners maybe, and hold on to them, realizing that, we could see a big decline down the road, and that's why we don't put everything in that one basket. So really, that's it for today. If you liked the video, would you please click the little box on YouTube that says like, and if you don't like it, you can do that also. Please leave a comment, something you liked about it or didn't like about it, or a question that you have that I can address, anything like that, be greatly appreciated. Other than that, we'll see you next week. All right, thanks for tuning in.